The Federal Reserve recently met for their June meeting, during which Chair Jerome Powell emphasized that the central bank is planning to raise interest rates at least once more this year. This decision is driven by persistently high inflation in the economy and the surprisingly tight job market. In May, inflation saw a 4% increase compared to the previous year, remaining above the Fed's 2% target. Although this figure was down from the peak of 9.1% in June last year, it has further to go to hit where they want it to be. The Federal Reserve has been aggressively raising its benchmark rate since March of last year in an effort to slow down the economy and reduce this inflationary pressure. In fact, in their June meeting, Fed policymakers finally decided to keep the rate unchanged after 10 consecutive hikes. This move allows them to observe the impact of their higher rates on the economy before making further adjustments. In particular, housing inflation has remained stubbornly high for months, according to monthly CPI data. Housing costs, particularly rent and mortgage expenses, play a significant role in most people's budget and subsequently greatly influence overall inflation. Nevertheless, economists believe that it likely has peaked and we may see a reversal in the second half of this year. This is particularly important as the Fed has been raising rates to curb inflation. Once inflation gets near their 2% target, they'll be able to hit the brakes and begin lowering rates, which will lead to a drop in mortgage rates as well. In the meantime, there are many people who would be buying new homes right now, regardless of rates, and they are being presented with one main challenge. It's a great time to sell, but then where will I live? While it may in fact be an opportune time for homeowners to sell their properties and make a good profit, the hard truth is that many face the challenge of finding affordable options that they would actually want to live in. Currently, mortgage rates are close to 7%, more than double what the rates were in 2021. As a result, there's a pent-up demand in the market with people who would be buying but have been holding out as long as possible. The likelihood of higher mortgage payments due to increased rate and prices poses this significant challenge for homeowners.
Welcome back to the Consumer Corner. Recently, we've been having a lot of clients contact us about buying their first investment property, which is extremely exciting for them. Have you thought about buying an investment property to rent out yourself? There are many powerful tools that investors use to get their foot in the door, and today we're going to highlight the rise of DSCR loans. DSCR stands for Debt Service Coverage Ratio. DSCR loans are geared towards investors and aren't used by someone to purchase a primary home property. The biggest difference between a DSCR loan and a conventional investment loan is that income does not play a factor in acquiring the loan. Now that may seem crazy, but your personal income doesn't matter to a DSCR lender. Instead, these loans are evaluated based on something called coverage ratio. Coverage ratio is basically a fancy word for cash flow, aka you can actually make money on the property. Even more simply put, the rent the property gets has to be enough to cover the property's expenses. If the coverage ratio is higher than 1-to-1, then with a good appraisal, decent credit, and adequate funds to close, a DSCR loan can close very fast, making it a very competitive offer. The equation to find your DSCR ratio is totaling the net projected income of a property and dividing it by the total net operating costs. So if a property will rent out for $2,000 a month and the total costs for the property are also $2,000 a month, the ratio is 1-to-1 and the loan is DSCR eligible. If your costs are too high and your ratio is less than 1, then the property is ineligible. Alternatively, if your rent is higher than your cost and your ratio is, for example, 1.5 or more, most DSCR lenders offer even lower rates because it's a safer investment. And in a few words, as long as your property can cover all the bills through its income, you're good to go. Remember, DSCR lenders are ultimately making an investment in you, and investments inherently have risk. So rates on these loans are a little bit higher than your average mortgage, and DSCR loans typically require anywhere from a 15% to 25% down payment, depending on the lender's specific requirements. Also, consider that the DSCR equation is very encompassing. Along with your principal mortgage payment, the lender will consider insurance, taxes, HOA, required repairs, maintenance, and declining market factors. If you're a savvy investor, you'll probably consider these too. DSCR loans are ideal for both first-time landlords or those with a portfolio of properties, and especially for investors managing multiple businesses that don't show a lot of income to the IRS, which would make a traditional loan impossible to get. This loan is also great for people with a current mortgage that would make them unable to qualify for a traditional second mortgage and more. The Shoemaker team does partner with great DSCR investors, so don't wait. If you're ready to invest, call us right away to see if you qualify so we can get your money working for you. Thank you for your time today. Now back to you, Chris.
According to the latest Fannie Mae Home Purchase Sentiment Index report, affordability constraints continue to prevent consumers from purchasing homes. Fannie Mae's Deputy Chief Economist, Mark Palim, highlights that consumers do not expect these constraints to improve in the near future as they anticipate increases or stability in both the home prices and mortgage rates over the next year. So what this means is costs are still keeping people from buying houses, and the average person doesn't think it's going to get too much better too soon. As a result, homeowners are holding on to their comparatively low mortgage rates. We have a lot of clients with 3, 4, 5% rates right now. And this trend is expected to continue due to the Fed's announcement of potential further rate hikes. Additionally, the ongoing housing shortage further complicates the situation. Many other would-be buyers are eagerly awaiting more homes just to become available. The inventory crunch in particular can be attributed to a decade-long home building slump and an overall shortage of houses that are needed in the US. During the pandemic, mortgage rates hit record lows, but then sharply rose. The low supply of homes is dampening sales, but many people are still looking to buy despite rates. Pending home sales have decreased 17% year over year, marking the largest decline in over 4 months. However, this decline cannot be solely attributed to the lack of demand. In fact, mortgage purchase applications have increased by 8% in the last week. And it's a good thing that these people are still shopping because homebuyers may not see a decrease in mortgage rates, even though the Fed just paused its series of interest rate hikes. The Federal Reserve's aggressive monetary tightening policies over the past year have put pressure on the housing market, and that's what we've been talking about. Although average mortgage rates have settled since peaking in late 2022, any further decline in rates could lead, and probably will lead, to an increase in home buyers and sales. Lawrence Yun, the chief economist at the National Association of Realtors, commented that the future direction of the housing market is almost entirely dependent on how mortgage rates evolve over the next few months. That concludes our July market update. Stay informed and make the right decisions in this dynamic market. Thank you for watching, and reach out with any questions, comments, or even corrections.